What is the risk of oversupply, too many units in some areas in Dubai, hurting rents and resale? That is the single biggest risk factor that a savvy Dubai investor must analyze right now. The answer is yes, there is a significant risk of oversupply in specific areas and property segments, which could hurt rents and resale prices in those localized markets, but the risk is not uniform across the city. Dubai's real estate is not a single market. It's a collection of micro-markets, and the coming supply wave is heavily concentrated in certain zones. First, the oversupply risk in detail. The primary risk comes from the large volume of apartment completions scheduled for late 2026 and 2027. While population growth is strong, the sheer number of units is expected to create temporary imbalances. A. Impact on rents, the immediate effect. When a large number of similar units, for example studios and one-beds, are handed over in the same district simultaneously, tenants gain leverage, rental compression. Landlords are forced to compete, leading to a temporary slowdown or slight decline in rent prices in the oversupplied area. This directly reduces client net rental yield, increased vacancy. The period between tenants may lengthen as a tenant can choose from 50 identical vacant units in the same area. Increased vacancy means lower annual profit. B. Impact on resale prices, the capital appreciation effect. Price moderation. Resale prices for apartments in these specific red zones are likely to see a period of stagnation or a potential correction. Analysts suggest localized corrections of 5% to 15% in the most saturated areas. This is because the new supply sets a temporary cap on resale values. Buyer selectivity. Buyers become highly selective, focusing only on the best managed towers with the lowest service charges, leaving lower quality developments struggling for attention. 2. The red zones, where oversupply risk is highest. The oversupply risk is highest in mid-market apartment communities, where land was plentiful and development was rapid. 3. The green zones, areas of resilience. These areas are insulated from the apartment oversupply because of limited land, high demand from HNWIs, or a focus on villas, which are undersupplied. Buyer strategy must be segmented. If buying off-plan for capital appreciation, avoid the red zones unless you are receiving a significant and verifiable discount that accounts for the risk of a 10% price correction at handover. Focus instead on prime green zones where scarcity is high. If buying ready-built for rental yield, target green zone apartments like JLT where tenant demand is stable and the supply pipeline is low, ensuring client cash flow remains robust. The general market is maturing, not crashing. Success lies in avoiding the specific areas and segments where supply is concentrated.